Today we are going to see about final accounts with adjustments, how we are going to prepare final accounts, how we have to prepare along with the format and a sample problem. So what is final accounts? In final accounts, every concern or every firm, they have to prepare final accounts at the end of the accounting year or at the end of the financial year. They have to prepare two statements. One statement is trading and profit and loss account. Another statement is balance sheet. Both will be prepared to give final results of the business. Trading and profit and loss account will give whether the business have achieved profit or loss in the business, and balance sheet help to analyze the financial position of the business. Usually preparation of final accounts is the last step in the accounting cycle, and there is a format for preparing final accounts for an accounting year. Usually an accounting year consists of 12 months. Either it will be a financial year or a calendar year. For financial year it will be 1st April to 31st March, and for the calendar year it will be 1st January to 31st December. So the first statement, trading and profit and loss account, has been subdivided into two categories. The first account is trading account. So there will be a debit side and credit side. So what are all the items appear on the debit side of the trading account? Opening stock and the purchases of the firm, then purchase returns. If you have any purchases returns, you have to deduct it from the purchases. Then you have to show the net purchases in the outer column. Then the direct expenses which are related to the manufacturing account or the manufacturing business or the trading business. Next one, the items appear on the credit side of the trading account, which will comprise of sales and sales returns. If there is a sales return, you have to deduct it from the sales and you have to show the net sales in the outer column. Then the closing stock of the business at the end of the accounting year. The second subdivision is profit and loss account. So what are the items appear on the debit side of the profit and loss account? The debit side, it will be allocated for the expenses. Expenses consist of operating and non-operating expenses. Operating expenses are directly related to the business. Or the expenses which are incurred in the day-to-day business of the firm. For example, administration or office expenses, selling expenses, if the business involved in sales, distribution expenses, packing expenses, finance expenses which involves money, and maintenance expenses for maintaining the assets and business. Then non-operating expenses, which consists of capital losses, like if you are selling an asset and you are incurring a loss, then the loss on sale of assets. Then preliminary expenses, like when you the expenses incurred while starting your business at the starting year of the business, those are called as preliminary expenses. Then if you have any intangible assets in the business, you have to write it off every year. So the writing off of intangible assets, these are all called as non-operating expenses. So these expenses appear in the debit side of the profit and loss account. Next one, items appearing on the credit side of the profit and loss account. What are the items we should write it down on the credit side? It is allocated to incomes, which is operating and non-operating incomes. Operating incomes directly related to the business. Like for example, if you are invested in bank FD, or if you are invested in any investments, you are receiving interest or dividend, then you are receiving any commission for your business, you are receiving any discount from your creditors, those incomes are called as operating incomes. What are the non-operating incomes? Like if you are selling an asset, you are getting a profit, so profit on sale of assets. And a business will pay tax every year. If you get any refund from tax department, such refund, those are all called as non-operating incomes, which are not directly related to the business. Operating incomes are directly related to the business. So next, the final statement we are going to prepare is balance sheet, which will depict the true financial position of the business. How is the financial position for the last 1 year? So to find it out, we have to prepare a balance sheet. For the balance sheet, there will be two sides. One is asset side, another is a liability side. So what are the items which will appear on the asset side of the balance sheet? First one is fixed asset. It includes both tangible and intangible. Tangible assets are which can be seen, which can be touched. For example, plant and machinery, furniture, your computer, your vehicles. These are all called as fixed assets, fixed tangible assets. What is intangible assets, which cannot be felt or which cannot be seen? For example, if you have goodwill for your business, if you have any copyrights for your business, if you have any patents, if you have any software for your business, these are all called as intangible assets. Both will appear under the fixed assets. And next one is current assets. It includes both liquid and non-liquid assets. Liquid assets is assets which can be easily convertible into cash. For example, cash, your bank balance, then debtors. You can easily convert your debtors into cash once they pay your bills. What are non-liquid assets which cannot be easily converted into cash? I mean, you can easily convert into cash, but it will take a lot of time. Those are called as non-liquid assets. For example, stock. If you have business, if you have stock in business, you can't convert into cash just like it. Like when you want it, you can't convert into cash immediately. You have to wait until it is sold out or until you do a good sales for that. So stock, it is a good example for non-liquid assets. And your investments. If you have any short-term investments, you're investing your profit or the amount in some short-term investments. Those are called as non-liquid assets because you can't easily convert it to cash. It needs some time. So both liquid and non-liquid assets comes under current assets. The last one is fictitious assets. It is nothing but it's not really an asset, but some kind of items which will come under fictitious assets. For example, your long-term profit on capital profit and your assets which cannot be easily written off. Those are all called as fictitious assets. So what are the items that will appear on the liability side of the balance sheet? The first and foremost item is capital. Capital is nothing but your own contribution for your business. So it includes, if it is a sole trading concern or a partnership firm, it will include the contribution of the owners. If it is a company, it involves shareholders funds, and if you took out any loan, so those are all comprises of like debentures. These are all comprises of capital. Along with, you have, if you have any reserves. Reserves is nothing but just like individual savings, it is the savings of the company. So that is called as reserves. So capital and reserves both comes under liability side. Next one is long-term liabilities, which is your long-term loans or long-term payables. For example, if you took out for a bank loan, or if you have a long-term liability which you have to pay, or your payment period is consists of more than 12 months, those are all called as long-term liability. The last one is current liability, or otherwise called as short-term liability, which is payment will be done within 12 months, below 12 months. For example, creditors. Whenever you purchase on credit, you have to pay it like within few months, like below 1 year. So that is called as current liability. Then if you have any outstanding expenses which you have to pay or which you have it to pay, those are all called as short-term liabilities. So these are items which will appear in the balance sheet. So what are the adjustments which we have to do in the final accounts? First one is closing stock. Usually closing stock will be given in the adjustment. What you have to do is you have to enter the closing stock amount in two places. One is trading account credit side. Another side is balance sheet asset side. Next one is outstanding expenses. So outstanding expenses is nothing but the expenses which are not paid, but it is belong to the current accounting year. For example, your current accounting year is April to March. So for the March month, you didn't pay the salary. So it is outstanding. Though you didn't pay the amount, it belongs to the accounting year. So it should come under the expenses side. So, and you also have to enter the outstanding expense amount in the liability side. Next one is prepaid expenses, nothing but usually we have to record the 12 months expenses and income in final accounts. So if you pay in advance, for example, your accounting period is April to March, 31st March 2010, you have paid the rent in advance for the April month. So it doesn't belong to the financial year, although you have paid it. So what we will do is we have to deduct the prepaid amount from the actual expenses, and you have to enter the prepaid amount in the asset side. Then accrued income is similar to the outstanding expense. This is outstanding income. Only thing is you have to enter the accrued income in the asset side. Next one is income received in advance, which is similar to the prepaid expenses. Only thing is you have to enter the amount in the liability side. Next one is depreciation assets. So usually assets loses its value every year. So you have, if you follow your depreciation reserve, you have to deduct it every year. Then you have to enter the amount in the profit and loss account debit side, and you have to deduct the amount from the asset, respective asset, in the asset side. Next one is interest on capital. So as a business and owners are so different. So you have to pay interest to the owners for contributing capital to the business. So such interest is an expense for the business. So it will enter in the debit side of the profit and loss account, and you have to add it to the capital on the balance sheet liability side. Next one is interest on drawings. Drawings is nothing but the owners have taken some amount or goods for the personal use. So they have to pay interest until they pay back it. So the interest on drawings will come under credit side of the profit and loss account, because it is a profit for the business or it is an income for the business, and you have to deduct it from the capital on the balance sheet liability side. Next comes bad debts. Bad debts is nothing but if you are selling goods on credit and you couldn't recover the amount, it comes under bad debts. So it will appear in the debit side of the profit and loss account, and you have to deduct the amount from the debtors in the asset side, because you lost the amount forever. You cannot recover it. Okay. Then provision for bad and doubtful debts is you are not sure whether you will give the amount or not. So it is little bit difficult, right? So you couldn't predict. So then you will create a reserve for it. So what you have to do is, when you create a reserve, you have to enter the amount in the debit side of the profit and loss account, and you have to deduct it from the debtors in the balance sheet. Next one is provision for discount on debtors. So for anticipating how much you have to give discount, or to cope up with the loss, the discount allowed to the customers, you have to create a provision. So you have to enter the amount in the debit side of the P&L account, and you have to deduct the amount from the debtors. Next one is provision for discount on creditors, which is similar to the debtors one. You are creating a provision. So right, you have to enter the amount in the credit side of the P&L account because it is an income for you. Then you have to deduct the amount under the creditor side in the balance sheet. So these are the common adjustments which we will encounter in final accounts. Now we are going to see a sample problem. So I'm going to read out the question. From the following balances on 31st December 2010, prepare trading profit and loss account and balance sheet as on that date. So salary rupees 5,500, rent rupees 1,300, cash rupees 1,000, debtors rupees 40,000, trade expenses rupees 600, purchases rupees 25,000, advances rupees 2,500, bank balance rupees 5,600, creditors rupees 9,500, sales rupees 32,000, capital rupees 30,000, loans rupees 10,000. So next one, adjustments. The closing stock amounted to rupees 9,000. 1 month salary is outstanding, which is yet to be paid. 1 month rent has been prepaid in advance. You have paid in advance. Next, provide 5% for doubtful assets, which is a reserve. So now we are going to solve the problem. So first I am going to prepare a trading account. So first thing, in the debit side, we are going to enter opening stock, just as we studied now. Opening stock, we don't have any opening stock in the sum, so it is nil. Next one, we are going to enter purchases. We have purchases amounted to rupees 25,000. Next one, that's all. So we are going to enter credit side. So we are going to enter sales amount, which is 32,000. Next, we are going to enter the closing stock, which is given in the adjustment, which is 9,000. So that's all. The total is 41,000. So what will be the gross profit? Your initial profit, 41,000 minus 25,000, which will be 16,000. So this is the gross profit. What we are going to do is, now we are going to prepare P&L account, where which we have to enter the gross profit. We are carry forwarding the gross profit to the P&L account. So now we are going to create P&L account. So I am creating profit and loss account. So there is two sides, debit side and credit side. First, I am going to enter all the items in the debit side. First, we have rent. We have rent amount of rupees 1,300, and there is an adjustment, that is we have paid rent in advance. So what I am going to do is, I am going to deduct the prepaid amount from the rent, because we have to enter only 12 months expenses or income. So we have paid here 13 months rent, 1 month in advance. So I am going to deduct the prepaid amount. So we are getting 1,200 rupees rent, which belongs to the accounting period. Next one, I am going to enter salaries. Salary, we have 5,500 rupees. We have outstanding, which means 1 month salary we didn't pay, which belongs to the accounting year, which means we have paid only 11 months, but we have to add 1 month which didn't pay, because whether you have paid or not, you have to enter 12 months expenses and incomes in the P&L account. So I am going to enter outstanding salary, which is 500 rupees, which is given in the adjustment side. So the total is 6,000 rupees salary belongs to the accounting period. Next one, we are going to enter trade expenses, which is 600. Then we have to create a provision for bad and doubtful debts. So how we are going to create is, debtors value is 40,000. So the provision is, the provision is 5%. So 40,000 into 5% belongs to 2,000 rupees, which is 40,000 into 5%. So 2,000. Next, for the credit side, we are going to carry forward the gross profit, which we have find out in the trading account, which is 16,000. So from 16,000, I am going to deduct 1,200, 6,000, 600, 2,000. So we are getting a net profit of 6,200. So that's how we are. So we have found a profit of rupees 6,200. Now we are going to prepare, the last step is, we are going to prepare balance sheet. So I am going to prepare balance sheet now. So balance sheet, we have two sides, liabilities and asset side. So I am going to enter liability side first. So we have capital of rupees 30,000. So to which I am going to add my this year profit, which is 6,200. So my total capital as on now will be 36,200. Then we have creditors worth rupees 9,500. Then we have loans which we have taken for the business, rupees 10,000. Then we have outstanding salary. So outstanding expenses belongs to liability, which means you are yet to pay. You have the obligation to pay, right? You have the you are accountable for that. So it will be a liability, a short-term liability. Then we have to enter the amounts in asset side. We have advances. Advances means we have given advance to somebody which we have to receive. So it will be an asset. Next one, we have debtors. Our debtor value is 40,000 last year. This year we have a provision for bad and doubtful debts, which is 2,000. So while we are deducting, our current debtors will be 38,000. Then we have closing stock. So we have to enter closing stock in the trading account credit side, and another side is asset side in balance sheet, which is 9,000. You have to enter only closing stock, not the opening stock. Next one, cash balance. We have cash of rupees 1,000. Our bank balance 5,600. Then we have paid rent in advance, right? So until it is accrued, like until the next accounting year, it will be considered as a short-term asset. So it is 100. So the balance sheet total will be 56,200. So this is how you have to prepare a final accounts. So this is how the format and this is how the system works. I hope you have understood the concept. Thank you.